Chapter 10 and 11 Exam Review. Question number 1. A machine originally had an estimated useful life of 11 years, but after 2 complete years, it was decided that the original estimate of useful life should have been 14 years. At that point, the remaining cost to be depreciated should be allocated over the remaining how many years? And the answer is 14 years revised life minus 2 years depreciated, which means the remaining useful life should be 12 years. Question number 2. When originally purchased, a vehicle costing $23,400 had an estimated useful life of 8 and an estimated salvage value of $1,800. That should have been 8 years. After 4 years of straight line depreciation, the asset's total estimated useful life was revised from 8 years to 6 years, and there was no change in the estimated salvage value. The depreciation expense in year 5 equals or should be what? On problems where you have a revision, the first thing you have to do is you have to bring the accumulated depreciation up to the point of the change. That's the most important thing in revising any kind of assets depreciation, is you bring it up to the point of change and then you do the calculation again. So here's what we want to do. The cost of the asset, which was $23,400, minus the salvage value of $1,800, that amount is going to be then divided by 8 years times the 4 years that have already gone by. And that means that we have depreciated $10,800. So the depreciation in year 5 is going to be the cost of the asset, which is $23,400, minus the depreciation to the point of change, which in this case is $10,800, we just figured that above, minus the salvage value, because you can't depreciate below the salvage value, and the result of these three things then divided by 2, which in this case would be, looks like 2 years left, means you're going to depreciate the asset for in year 5 for $5,400. And you're doing this by 2 because there's only 2 years left in this asset's life. Remember, it originally had an 8-year life, then they revised that down to 6 years, and you've already gone by 4 years. So if it now has a 6-year life and you've already used up 4, you've got 2 years left. So years 5 and 6. So in years 5 and 6, you'd be depreciating it on a straight line basis of $5,400. Question number 3. Company purchased a delivery van for $27,700 with a salvage value of $3,100 on September the 1st of year 1. Remember now, this is not going to be a full year depreciation because we're buying it in September. It has an estimated useful life of 6 years. Using straight line depreciation, how much depreciation expense should the company recognize on December 31st of year 1? Well, how many months are going to go by from September until December? Looks like September, October, November, December. So that's 4 months. So the depreciation calculation will be the cost of the equipment, delivery van in this case, $27,700, minus the salvage value of $3,100. That result is then divided by the 6-year life, and then and that would be all it would be to it if you were going to have a full year, full 12-month year, but you're only going to have 4 months, so you're going to multiply that times 4/12, which means the depreciation for year 1, that short year, will be $1,367. Question number 4. PV Enterprises purchased a depreciable asset for $32,000 on April the 1st of year 1. depreciation, right? The asset will be depreciated using the straight line method over its 4-year useful life, assuming the asset's salvage value is $4,000. What will be the amount of cumulative depreciation of this asset on December 31st of year 3? So year 1, we're going to be a partial year, and it's going to be depreciated for 9 months from April through December, which is 9 months. So we'll say $32,000, the cost, minus the salvage value of $4,000. That results in $28,000 that you can depreciate, divided by 4-year life, and then multiplied times the number of months in this year 1, which will be 9 months. And so in year 1, you're going to depreciate $5,250. Year 2, it'll be a full 12-month year, so it'll be the $28,000 divided by 4, which is in this case, a 1 full year, $7,000. And in year 3, it'll be still another full year, so it'll be $32,000 minus 4, and we're talking about $7,000 a year in that full year. And then so you add those 3 years up, $5,250, $7,000, and $7,000. And so at the end of year 3, the accumulated depreciation on this piece of in this case this asset will be $19,250. Number 5, PV Enterprises purchased a depreciable asset for $29,500 on April the 1st of year 1. The asset will be depreciated using straight line method over its 4-year useful life. Assuming the asset's salvage value is $3,500, PV Enterprises should recognize depreciation expense in year 2 in the amount of what? Well, you take the cost of the asset, which is $29,500, and minus the salvage value of $3,500, and that result is then divided by 4, because this is in year 2 a full year. Year 1 was a partial year, 9 months will be depreciated, but year 2 is a full year. So the depreciation expense for year 2 will just be 1/4 of that total, which in this case is $6,500. Question number 6. The following information is available on a depreciable asset owned by a mutual savings bank. The purchase date was June the 1st of year 1. The purchase price $95,500, salvage value $11,800. The useful life was 9 years, and the method was straight line depreciation. So the asset's book value is $76,900 on June the 1st of year 3, and on that date, they just told you that, they gave you that. On that date, that is June 1st, year 3, management determines that the asset's salvage value should be $6,800 instead of $11,800, $6,800, rather than the original estimate of $11,800. Based on this information, the amount of depreciation expense the company should recognize during the last 6 months of year 3 would be what? Well, again, like I said, anytime you have a revision, the first thing you have to do is you have to bring everything to the point of where the revision starts. So the year 3 book value would be the book value at that point, which would be $76,900, minus the revised salvage value, which the revised salvage value was $1,600. That result divided by 7, and there's 7 years left, times a half a year, because we're dealing with, in this case, looks like, and that was at June 1st, yeah, for half a year, because we're going from June the 1st to the end of the year, so that's half a year, would mean that the second half of the year 3 depreciation would be $5,007.14. Question number 7. A total asset turnover ratio of 5.1 indicates that Well, it indicates that for every dollar in assets, the firm produces $5.10 in net sales for that particular current time that was measured. So you're generating a little over $5 in sales for every dollar you have in assets. The higher this number, the better, and the more efficient your business is. Number 8, a company had average total assets of $960,000. Its gross sales were $1,110,000, and its net sales were $935,000. The company's total asset turnover equals what? Well, you always use net sales. You don't even bother with average total sales. You use, you don't use gross sales. You use net sales, which in this case would be 935. So again, let me repeat. You don't use average total. Let's start this over. A company had average total assets of $960. Its gross sales were $1,110,000. Its net sales were $935. The company's total asset turnover equals what? It equals net sales, which would be $935,000 over here, divided by average total assets, which are $960, and that means its total asset turnover was 0.97, almost 1 to 1. Question number 9. Spears Company had net sales of $42,404,000. Its average total assets for the period were $15,202,000. Spears' total asset turnover equals net sales of $42,404 divided by average total assets, in this case of $15,202, and so its average asset turnover is 2.79. Remember, higher is better, and you want to compare this to what you've done in the past and also to other companies in the same industry. Question number 10. Merchant Company purchased property for a building site. The costs associated with the property were purchase price $187, real estate commissions $16,200, legal fees $2,000, expenses of clearing the land $3,200, expenses to remove old building $2,200. What portion of these costs should be allocated to the cost of the land, and what portion of these should be allocated to the cost of the new building? Well, these are things you can look up in your book. There are certain rules that accountants go by for allocating these things, and the answer to this question, let's see, is the total cost we're looking at to the new building is going to be for this property. Okay, we're looking at $187,000 for the purchase price, plus $16,200 real estate commissions, plus $2,000 for legal fees, plus $3,200 for expenses of clearing the land, and $2,200 expenses to remove the old building. So the total will be $210,600, and a textbook answer would be the entire amount of the cost should be allocated to the land since the new building is not yet constructed. So all of these things go to the cost of the new land. Question number 11. A company purchased property for $100,000. The property included a building, a parking lot, and land. The building was appraised at $59,000. The land was appraised at $47,400, and the parking lot was appraised at $18,600. The land should be recorded in the accounting records with the allocated cost of what? Well, let's see. You bought some of these land, building, and property, and so forth, so on, and you spent $100,000. And you can see that the appraisal price is higher. You can see that 59 plus 47 plus 18.6, that is more than $100,000. So you bought this at what's called a bargain purchase. And so if you're trying to figure out how much of this $100,000 should be allocated to the land, then you're going to use what's called the relative sales method. And the relative sales method says that of all these things you purchased, you figure out what the total appraised value was. So the total appraised value is going to be 59,000 plus 47.4 plus 18.5. You add all that up and you divide it, and those are your appraised values. You add all those appraised values up and you divide those into the appraised value of the land, which is 47.4. This gives you some kind of a fraction or some kind of a decimal place, and you then multiply that result into the or by $100,000 cost, which means that of the $100,000 you're going to allocate $37,920 of that $100,000 to the land. You do the same thing to the parking lot. You take 18.6 and you would divide 18.6 by this resulting number and get that fraction. Anyway, when all the smoke clears, you want to make sure that the allocated cost of the land and the allocated cost of the parking lot and the allocated cost of the building all total $100,000. I think we're done.